Investor appetite rose in October to a 6-month high, but fund managers stopped short of forecasting a longer-term return to riskier assets. Those are the key findings of a Reuters survey of 57 leading investment houses in the US, Europe, Britain and Japan. Allocation to equities rose to 50.4% in October, up from 49.3% the previous month. Investors raising their holdings of government securities to more than 50% from 46.7% in September. And cash holdings fell to their lowest levels since February. To discuss, we're joined from Amsterdam by Joost van Linders, investment specialist in allocation and strategy, BNP Paribas Investment Partners, and Lee Robertson here in London with me, Chief Executive at Investment Quorum. My thanks to both of you. Lee, let me kick it off with you. 6-month high for equities. Are you surprised at that given the earnings season record so far?
I think probably not. I think what's happening is that investment managers are working on behalf of their clients. They're looking for yield. They're getting rather fed up with the low yields on bonds. Cash, of course, negative real returns. So I think that's the general move towards equities.
Similar question to you. 50.4% for equities. Is this as high as it gets?
Yeah, well, as far as we are concerned, yes. We also increased our equity holdings. We did it a bit earlier, basically before the summer. It's also the rally that we've seen in equities, attracting more people to the equity markets. It's basically monetary policy. We think you mentioned earnings. The earnings season is not good. Economic data are mixed, I think. So yeah, we think it's as good as it gets. We are at 40% equities, which is close to our benchmark.
All right, Lee, cash holdings lowest since February, joint lowest in a year. Do you expect that to continue falling?
I think probably, yes. All the central banks are keeping interest rates extremely low. Investors are becoming very disenchanted with cash returns, so they're looking elsewhere.
I say lowest in a year, 7.2% of portfolios. Is this just still a sign that investors remain cautious?
Yeah, to some extent, I think, yes. I mean, cash is the ultimate safe haven. With the yields so low, you only hold cash for precautionary reasons. In that sense, it's still a bit elevated. It's also not surprising that it's falling, of course. The tail risk in Europe has been lowered significantly by the ECB with its new bond purchasing program, and in the US you have QE3 or QE Unlimited basically, which also reduces some of the downside. So it makes sense to lower it, but given uncertainties in Europe, there are several. In the US, emerging market growth is not that strong. It makes sense to have some, I guess.
Sure. All right. Joost, I want to stay with you. Government bond holdings, Eurozone bond allocation, highest since May. I imagine we're talking mainly the periphery here. Are the core markets too rich, do you think, right now?
No, I don't think so, actually. When you look at growth in the Eurozone, that is low. And when you look at the recent indicators, the leading indicators are basically still falling, also falling in the core in Germany, France. Unemployment is rising, and inflation is still somewhat high, around 2.5%. Core inflation is much lower, so this inflation can come down. And in such an environment, in an environment of low growth going into next year, I don't think that core bond yields are too low at this point.
All right. Actually. Lee, this shift, this momentum, if you like, the bond allocation in the Eurozone, is this a sign that there is a respite in the crisis, that investors think there is a respite in the crisis?
It certainly appears to look that way. I think with all the statements coming out of the ECB, with Draghi saying he will do whatever it takes, I think this is exactly what's happening. Clients are thinking the tail risk is not so bad. Things will survive. We have some slight views still on Greece, but I think people think that Spain will stay in. Greece will probably stay in. That seems to be being picked up.
Will probably stay in.
I think that's the view.
I think what we've said in the survey, 15 versus 3 saying Greece will still be in the Eurozone at the end of next year. is where we stand right now.
I think that's entirely likely. As I say, we still have views on Greece that ultimately they may not stay in, but I think we've seen that Europe is very good at kicking the can a bit further down the road. So I think by the end of next year they probably will be in. Yes.
All right. Your geography. I want to talk a little bit about that. Equity investors still favouring North America. S&P near a 5-year high. Emerging markets are slowing. Is that shift going to change anytime soon?
Well, when we think about the US, we think growth will stay about where it is now. We think the fiscal cliff will be avoided, but we still have a fiscal drag going into next year, we think. Emerging markets, they could come back a little, but at this point we think that monetary policy is more favorable for developed equities, and that is the US and to some extent also Europe, than for emerging equities. Emerging equities, we've seen some rate cuts. We think that will come to an end with inflation bottoming out. So in a relative sense, it's less attractive for emerging markets. So we are more concerned about emerging equities at this point than for developed equities.
All right, Lee, what do you think is the biggest risk to portfolios next year?
If the Chinese slowdown continues, I think that's the big issue. Of course, the secondary one is the US fiscal cliff, but I agree with you that I think America will avoid it. They will get together and get this sorted.
All right, just want to finish up. Same question to both of you. Lee, let me start with you. Who's going to win this election, and what is it going to do to the investment climate?
I think it's an incredibly tough one to call. I mean, they're really neck and neck. Sandy's, they're having to stop polling in effect, I think. I suspect Obama will just sneak it. If he does, I think that will favour bond markets. If Romney gets in, I think that will favour equity markets.
What do you think, Just? Just, what do you think? Who's going to win the US election, and how do you play it?
Yeah, I agree that it's very, very tough to forecast given how close the two candidates are. I also agree that it's likely that Obama wins with a narrow victory. In terms of we don't really play it in our asset allocation. We don't think there will be a victory for one of the two parties in the presidency and in Congress. So you still have a divided situation. You will still have problems finding a solution for fiscal policy next year. We tend to think that markets usually rally after the election, regardless of who wins. But then next year, with the fiscal situation and the debt ceiling coming back on the agenda, that could prove to be a difficulty for equity markets, regardless of who wins.
All right, Just, many thanks. Just van Lenders, BNP Paribas Investment Partners, and Lee Robertson from Investment Quorum. My thanks to you as well, Lee. That's it from me. I'm Axel Throlfall. This is Reuters.